All right, everybody, welcome back to the Cashflow Chronicles. It is October 21st, 2025. I'm here with Chris Patel. Good to be here. Good to chat. It'll be fun. Chris, a really good episode with you and Mr. Fiorillo yesterday. So I really enjoyed watching that, and hopefully you guys were able to do the same. But as always, we're here to talk Cashflow Chronicles. So contemplate becoming a member or subscribe. Subscribe is completely free, allows you to participate in the chat. Before we get to the topics at hand, let's talk about some of the key tickers. Apple, close to all-time highs, 262. Amazon, 220. Dutch Bros, 57.70. Google, 255. Palantir, 181. Rocket Lab, just below $65. SPY, 671. The Q's 610. Bitcoin pulling back below 110,000. Oil still below $58, and Henry Hub gas spiking up to $3.50. Mr. Patel, how are things?
Good, man. I'm surprised you don't have like TLT on there, considering where we are in the current market cycle. I mean, look at this 10-year. It's literally been on this nice downward trajectory for the past month. Now, some of this people are thinking that, oh, this is just people like, going risk off and just buying safety. But I'm like, yeah, I don't think so, man. I think there's something more to it than that. I think the bond market especially is sniffing out a lower inflation environment that's upon us. All the data, even though the data is kind of paused from BLS, so we don't really know. I think there's a ton of hints all over the economy right now. So, I think at this point we can safely say inflation is well. I wouldn't say, it's got one foot in the grave, basically, and then you got, what's his name, from the All In Pod. He actually posted something, Jason. He posted something that I actually saw a couple of days ago myself, and I was like, okay, yeah, things are going according to plan. So just share that.
Yeah, I feel bad. I feel like I prefaced last Tuesday, I was talking about how people should be cautious about some of these stocks, and some of them are down 20-30%.
Yeah, dude, my hedges are, I don't know if did you buy any hedges by any way?
No, but I know you did.
Yeah, I bought some hedges on the quantum names. They're doing well, bro. That's what's holding my portfolio nice. Like a lot of the cruise lines have done really good over the last couple of weeks. UNH has done extremely well. So all the healthcare names, I played it smart like a few months ago by rotating out of a lot of tech using my 401, and same thing with my wife's 401, and rotated into the managed healthcare side. So that's been doing nicely, so I think a lot of times people they get too bulled up on tech, and I'm like, yeah, but you gotta look for value sometimes too, man. So I still remember a lot of people were giving me shit when I said like, hey, would you rather buy Nvidia or rather buy UNH? And I'm like, I'd rather buy UNH. They're like, are you stupid? I'm like, yeah, I guess I'm stupid. But this was actually a really interesting chart, just showing just a lot of the places in the country, they're starting to kind of rents are starting to come down. The impacts of what are they called? The deportations, I think, are starting to have an effect. And then the population growth rate, from what I saw, is going to be about net after deportations and everything else might actually be negative this year. It hasn't happened since like I don't think it's actually ever happened, to be honest with you. So the amount of people that are being born in the country versus deaths versus net migration is so low, and it's actually to the negative side now that we're getting to the point where I think services are going to start to get impacted. And one of the things that I was reading, because like I told you, I was talking about Verizon yesterday with Steve. So one of the things that I actually read about was just now that there are, like I said, almost 2 million people leaving the country, and then projected another 2 to 3 million leaving by the end of the Trump era, we're likely to see a pretty big significant move down in total postpaid consumers for the telecom industry. Now, of course, the telecom industry is widening. There's more nodes that are always being connected, but it's kind of crazy to see that how this is happening. So I know people think like, oh, like what does this mean for us? I would say that if you ever look at how the population like growth curve works, is that every year the population increases slightly, and that's more people that enter the labor force. So there's more productivity, and then you have like GDP growth. But now you've got this reverse thing happening. So you might actually see a slowdown in GDP, but then it's also being kind of, what is it called? Being boosted by AI, right? So productivity is jumping on a per person basis. So we might actually get a very weird scenario where our GDP continues to grow, but we might actually get prosperity. So what tends to happen for the most part is inflation goes up 3%, wages go up 3%. So what really happened? Nothing, right? Like you made 100 grand last year and inflation went up by 3%, and your boss says, here's a 3% raise. It's like, okay, great. You basically just let me survive on what I already make. On the other hand, if your pay goes up by 3%, but inflation stays at, 1 or 2%, that's when you're actually making more money and actually getting to be, you're getting some prosperity out of it. So I think if there's somehow we can get costs to come down for the average person, but keep wages where they are and actually elevate them slightly, I think we could have a nice, like soft landing. The thing is, this administration is going to have to do, it's going to have to really put in the work to get a soft landing out of this whole thing. So we'll see what happens.
Yeah, I'm curious because a lot of these show up to me as areas that a lot of people were flocking to during 2022 and during the pandemic. And so I don't want to say these are selective in terms of, but I feel like that those might be a slight, those might be more exaggerated in terms of overall versus other locations. Like I'm curious what Houston looks like, because Houston still has pretty decent job growth. So I know that I can feel just based off what I'm looking at in the market that rents are coming down because of building here in Houston, but I don't feel like it's coming down 10%, but I could be completely wrong. So I could definitely tell that things are flattening though, for sure, if not slightly decreasing. But this is more other metropolitan areas, or
so these are some other areas where you're starting to see kind of like home prices coming down. Like, so Punta Gorda, Florida is probably the worst in terms of impact. Like a lot of places in Florida are getting hit the hardest, but I think there's a lot of changes that are happening in Florida too from a legislative standpoint. So one of the things about Florida is that after this that building that collapsed, there's like this whole thing with structural changes that are happening with insurance in Florida, that a lot of condo communities and stuff, they're having to do assessments. And the thing is, sometimes the assessments are actually more than the actual like at the condo is worth. So a lot of people are kind of stuck in condos that they may or may not be able to afford the assessments on. So they're sort of being forced to sell. Right. So that's a problem. And so right now, if you look at just the number of places in Florida, it's pretty high. Texas, during the pandemic boom, Texas didn't close down nearly as much as the Northeast did. And so Texas was just building like crazy homes. Right. So that's one of the things that like I would hope that New York takes up, New York and some of the Northeast, that they're always advocating for housing affordability. Right. But if you look at like these idiots like Zoran Mandami from New York, they're all about, we need to control rent prices. Now, the problem is when you control rent prices, you basically destroy any profit motive to build more units, right? So that's the thing. Like these guys that they come in thinking that they're doing great for the people by trying to control and cap rent artificially. All they're really doing is stopping additional supply from coming in. And then when they do that, they're causing, housing to actually become more expensive because the amount of supply is not coming in. Whereas Texas is smart and saying, hey, we've got the land, let's build. And so now you've got this supply of homes that now people can actually occupy. So if you want people to have an affordable living, like an affordable home, don't do this bullshit with trying to control rents and artificially jimmy up like, public sentiment. Figure out how to build more homes, So
yeah, I think I'm okay things being down 3-5%. I don't think that that's bad. I mean, I guess as long as it doesn't happen or persist for, say, several years in a row. So I mean, if we kind of have some sort of retracement here, for say a certain amount of time, and then this is from 22 to 25, right? So this isn't like it's year over year from 24 to 25. No. So this is from
literally this is from 20. This is from 24 to 25. Actually.
Oh, this is from 24 to 25. Okay. The last one was from 22 to 25. Got it.
Yeah.
So this is from 24 to 25. Okay, that makes more sense. Yeah.
The last one was happens for rental. Yeah, that was the last one was for rental prices. This one is like homes, actual like price.
This is home prices. This isn't rents. Okay, got it.
Yeah.
Okay, sorry, I thought this was rents as well. Because the way I was looking at it was like, if rents are going down, say 3 to 5%, that's fine with me. Especially if the way I'm looking at it is if I can refinance some of these mortgages and get them into fives, then it'll end up being probably a net positive overall. But because I've already locked in the prices, of course, it depends on what the value of the homes are, right? Obviously, they have to maintain that loan to value ratio, but a lot of them I put down 20 to 25%. So hopefully, fingers crossed, they'll be able to sustain. But anyway, we'll see.
The good thing is if you're able to have lower home prices like this, and you also still, you're still able to get wage growth, that means that the prosperity in these areas starts to kind of go up. Because I mean, right now, if you look at housing affordability, like an Atlanta Fed does a really good job of actually highlighting this.
Hella great. Thank you for the 10 gifted, my man. Much appreciated. Get to the chopper.
So the Atlanta Fed, they have this thing called a housing affordability monitor, and what they do is, they use some of the data from like the median income of certain areas, and then they see what kind of price of the home is going to be, and then they actually like list out what the gaps are, right? So if you look at here in the United States, if you want to afford a home, right, the average median household income in August is like $80,000 a year, but the average it takes to comfortably buy a home, not actually like buy a home, but comfortably buy a home, is around 124. And the main reason why is because interest rates have spiked so much since 2020, and then the price of actual homes has gone up so much, and then you have taxes, all these other things. So this is where affordability is just it's rough, man. So you can actually look this up and put it towards like every individual like market. Like we can look one for some of the ones that we saw, but like right now, if you look here in August, principal and interest would cost you on an average home in the U.S. Like $2,300 plus $200 for property taxes a month. No, $400 for property taxes a month, and then PMI for insurance. So your total is $3,100, right? If you want to be comfortable, you have to spend no more than I think 30% of your net income.
Mm-hmm. Yeah, I think the rule is 38%. I think is what the banks look at.
Yeah. So these are some challenges, but if you look at on like a metro view, you can actually look at individual areas. Like, so which one did you say? Houston?
Yeah.
So Houston, Pasadena, Woodlands. So you can see affordability is still beyond the reach for a lot of people. Like the median income around your area is about 82,000, which is okay, and then the median home price is 370,000. Now, one of the things is you see that interest rate there at 6.6%, but if let's say interest rates came down to 5, right? Like this one, like around here, it was like 4.8, and the median home price was 248. But at the time, the median household income in 2018 was 67. So the median household income will still be 82. But if the price of, let's say, the interest goes down to, like, let's say 4.5% again, then that means that the median home price is actually affordable, right?
Mm-hmm.
That makes sense. So I think the key here is, what is the Trump administration going to do to get this affordability back? So I think it's going to be a combination of, home prices, not necessarily doing the 2008 Macarena where everything just kind of crashed, but it's going to be like it stays flattish for a good amount of time, and then wages will catch up, and at the same time interest rates will come down. So then if eventually the affordability comes back to somewhat normal.
So do you think that what's going on with the markets right now, the government shutdown, the rise in unemployment, all that is feeding into, and then obviously the unaffordability here, or lack of affordability rather, is probably a better term for individuals around the United States, is all feeding into the need to cut rates. I mean, obviously, I think everyone, and even the Fed, noted that there'd likely be, when they cut last month, that there would be a likelihood of cutting two more times throughout the rest of the year, which there's only 2 more meetings, right? So likely that it's going to be both meetings, that there's going to be a 25 basis point cut in both. So I guess my question is do you think they need to be more severe? Do you think they need to forecast more like a full percentage point over the next, say, 6 months? Or is it more that they're starting to see the shakiness of other economies as well globally that is causing them to kind of feel like they're getting on a boggy territory that needs to have them proceed with caution?
I would say if it wasn't for AI, I think we would have already cut about 150 basis points. If you look at the total GDP growth that we had this year, I think it was like 0.1%, but then you add all the additional spending from AI CapEx boom, and that kind of brought the GDP growth rate to a much higher level. So, the challenge that you run into going forward is that you can't rely on the AI CapEx, the data center CapEx, to be unlimited forever, right? It's not to say that, like, AI CapEx is going to just go negative, but you can't expect that huge growth rate that actually boosted the entire GDP to stay with us forever. That only makes sense. Like, these companies are spending way out into the future. They're spending a lot of that cash flow right now. So, eventually the CapEx growth rate is going to moderate, and so the economy is going to have to stand on its own 2 legs. And the thing is, right now, at the lower end of the lower end of consumer is definitely struggling. So, the other challenge that you run into is also from credit events. The longer the Fed keeps rates where they are, and then the consumer starts to deteriorate, so that delinquency rate, if it keeps rising, then you've got yourself an issue with. Let me just hold on one second.
I want to get some clarity on something. You said we already would have cut 150 basis points. So we're already cut 125 basis points since the peak. Do you mean an additional?
No, this year.
Got it. Okay. So instead of just the 50 basis points to 75 basis points, we would have cut much more aggressively over the past 10 months.
Yeah, exactly. So right here, you can start to see, like, credit card, what is that thing called? Credit card loans are starting to, they're getting elevated. They're nowhere near what they were in the past, but other things are starting to rise. I think, what's his name? Apollo actually put a great post on this with Torsten Sloke. Apollo. Let me see. Yeah, this was the one. Let me just stop sharing this one. So, okay, there you go. So if you look at this, like the slower immigration is a key reason labor market is weak. So what happens is if you have all these people coming in, like immigrants coming in, yes, it's difficult for the country to manage, but then the government tends to step in and start spending, and those immigrants, they go out there and they go buy stuff and they get haircuts and everything else. So if you take away those people, you're going to see the labor market, start to go the other way, because now all the services that those people were providing to these new arrivals is starting to go in that other direction, right? Um, so it just means that a lot of those people that were working towards, taking care of people and getting people integrated, it goes into reverse, right? So now what are those people supposed to do? And they're supposed to find jobs in the other parts of the economy. But you can see here, generative AI, where was it? Yeah, right here. So before, when all of that stuff was happening, you can see here there was a tremendous amount of job growth, and then over 23 you had this huge immigration wave, and so the administration was just pumping liquidity into the states and spending money on their own, what is that thing called, uh in their own programs. And so the job growth on the government side started to really climb up there, while private sector started to kind of go down, and now it's actually like leveled off around 1%, but government is going the other direction. So it's almost like the labor market is normalizing from a very weird period that we had from 2022 to 2025. So I think now we're looking at a lot more durable growth going forward. So a lot of the stuff that we had, like basically this giant wave of spending and hiring that we had in 22, 23, 24, it's going in the other direction. So a lot less people, I think, have the ability to just, move jobs all the time and, keep looking for more opportunities. So now people are staying put. Employers are recognizing that, so they're not having to pay crazy amounts in wage growth. I remember I don't know if you remember this, 2, 3 years ago, people were so desperate for workers that they were willing to pay. And so workers had the ability to kind of negotiate kind of heavy handedly, like, hey, I want like a nice fat raise. Well, people don't have that ability now. So that alone can help inflation starting to come down. Now, of
Mhm.
course, some people will say, well, there's other parts of like the economy that inflation is starting to rise. Like from the ISM survey, you're starting to see like goods inflation starting to rise a little bit. But it's like, I look at this and I'm just like, dude, look at the price of oil. Look at the price of energy. That's coming down so significantly that I think it's just kind of making up the difference anyway. So,
Do you think it's more of like somebody said that the term normal, then there's a debate of what's normal. The thought process is that I'm kind of thinking is, do you think it's just retracing back to what a typical year over year growth would be? Because obviously we saw uh, housing almost go up at an exacerbated rate from 21, 22, and now you've started to see it, come back a little bit. It reminds me a lot of um, the uh, e-commerce as a percentage of all retail sales chart. It reminds me a lot of this. If this is almost, let me share here. If this is almost what's going on. So if everybody remembers, everybody and their mom was buying through Amazon and everything. I don't know why it's not letting me scroll in. There we go. Everybody and their mom was buying through Amazon. Obviously, during the pandemic. What the hell's going on? And so what we're looking at here is on the left-hand side, you're seeing the percentage of total retail sales in the United States specifically. And you could see, obviously, during the pandemic, it all spiked up. It went from an average of about 11% all the way up to like 16.5, 17%. And then it kind of retraced back. And if you kind of put this back on, this is one of the reasons why Amazon was a good buy in 2022, is because everyone started to realize, oh my God, they overbuilt all these warehouses. And it just took time, for things to kind of fill out because they were investing so heavily. And I feel like it's almost the same, right? They were so used to all these prices for homes and buildings to being able to get such a price. Now you almost need to have this kind of revert back to the mean. Now it's not to say necessarily that it's going to say blow through this point and actually have like 15 or 20% sort of corrections or anything like that. And there will be select markets that do, and there'll be select markets that actually continue to continue through this cycle. Like I've seen prices in my sister's neighborhood back in Pennsylvania that have continued to be fine. But and same thing with the area that I have homes in New Jersey continue to remain fine. But here in Houston, I'm seeing prices get cut, $5,000-$10,000, every couple of weeks because they're just sitting on the lot. So I guess my question is I feel like, or my thought process is, it's almost something like this, where you've seen this massive spike up in year-over-year prices in 2021, 2022, and now you're starting to see the comeback, but eventually you'll level off and then start to grow again. And so my thought process is kind of just that. I don't think it's the death of all housing sales or anything like that. I just think it's a slight cooling effect comparatively to the seller's hot market that we were, right? People were buying homes and then a year later selling them for 20%, 25% more. It's like, that's unheard of, right? Like when generally speaking, you think that you might be able to get maybe 2 to 5% year over year price increases, to get 20 to 25% is just absolutely insane. So, anyway, some thoughts.
Yeah, I think for a lot of things, it's just, you have these periods where things go up a lot and then they kind of come down and then they adjust, right? And a lot of those things are policy driven. They're driven by demographics shifts. I personally, when I look at like housing, I'm seeing just everyone getting to the point right now where there's a lot more inventory that's going to be coming on the market in 26. And with that, I think prices are going to be a lot more muted, in which case now, shelter makes up 30% of CPI. Energy makes up a good portion of it because it feeds into everything else. Like, yes, will services, some of them, be a little bit more elevated? Will goods prices be a little bit more elevated year over year? But then again, you also have like the tariff impact is going to be muted by then, right? That's the other question too. Like everyone is saying the tariffs are going to cause like this massive spike in inflation, and so far, basically, it's been eaten by the producers and the companies. So I don't even think that inflation is going to go up that much with tariffs. And yeah, I mean, if that's the case, then I don't know. I just see a much lower interest rate environment going forward in the next couple of years, right? So I think the 5 handle on the US on the 30-year mortgage is not completely unreasonable.
Yeah.
What do you think about that?
Sorry, what was the question?
No, I'm saying a 5 handle on the mortgage rates is not completely unheard of. Like I think
I mean it's going to be
away.
I think the 15 years already dipped into the 5s, and
has it?
The 30 years are probably at 6.25 or 6.125. So yeah, I mean, I think you just need to take the 10-year, and I think at one point the 10-year there was a 3% spread. It was actually some of the widest in history, a 3% spread between the 10-year and the 30-year mortgage, and that was kind of historical. Generally, the normal point is about 2 to 2.25% from the 10-year. So the fact that we're slightly below actually. 2% spread is actually pretty good for the 10-year versus 30-year mortgage.
There it is. Yeah, so you can see here, this is the one that's dashes. Actually, let me just change that. I don't know why the Fed, the stupid thing, like does that, where they do dashes instead of just do straight solid lines. Just come on, guy. There we go. There you go. So you can see here that the Fed funds rate, the 10-year Treasury is in green, and the mortgage rates are in the in blue. So as 10-year comes down, mortgage rates should come down as well. So I remember last September, mortgage rates had gone down to like 6, And I think a lot of people were starting to buy at the time. I know a bunch of people that they saw that 6 handle on the mortgage and like inventory, because it was like the latter half of the summer where there's a lot of inventory that, you know, is basically sitting on the market with people willing to kind of drop some prices on. Dude, there was a rush to buy homes. Everyone was like, oh, let me get that 6% lock in. And I think that's what's going to happen again. So if rates here kind of drop down to the 5s, right? So you would need probably a 3 on the 10-year, right? If you can get to about 3, then we could see, you know, mortgage rates back down to 5%, in which case I know it's going to cause a refinancing boom with a lot of people who bought homes over the last 4 years. Well, not 4. Is it 4 years now?
Yeah.
I mean, but
since
wow.
22. We're entering the 4th
So,
year. Yeah.
Yeah. So over the last 4 years, a lot of people are going to be refinancing down. The question is, are they going to have enough equity to finance? Because if they bought at the top of the market, they may not necessarily have the equity. So that's what a lot of people forget. A lot of realtors that are shady, they'll tell you that, oh, just buy the house, marry the house, date the rate. But they never tell you, like, hey, when you're dating the rate, you know, your home, in order to refinance, has to maintain a certain level of value. If the value, like the appraisal, comes down on it while you were living there, then when you try to refinance, they're going to say, hey, listen, you got to cough up some money for that equity. And they'll be like, but I paid X amount of dollars for it. And they're like, yeah, but the home isn't worth what you bought it for. So what are you going to do then? Right. So like, but I don't think it's that big of a deal. Cause like, if you look at those houses in like Punta Gorda, if your home was like 500,000, it's down 10%, and you put down 10% when you bought it, yeah, then you're screwed. But that's like an outlier, that rather than like what's normal. Like what's normal is people bought homes in 22. If anything, their home prices have flattened rather than gone up 10-20%. Right.
No,
Which
we
means that they have
we bought a house in 22 and we just got it reappraised because we had put down 10% and it went up by about 15%. So we no longer have to pay the PMI on it, which is great. So that was at the peak of the market, technically.
I'm glad you said that. A lot of people don't know that you can actually do that. Like, so I've never done it. So maybe you can explain what the process. Reassess, like done a reappraisal to get rid of PMI.
So I have 2 scenarios. Okay. So, and a lot of people, so once again, right, like with the stock market, you know, you have to do what's right for you, right? So there's a lot of people out there that say, never put less than 20% down, PMI is a scam, whatever. You got to do the mathematics, right? So I asked my realtor, I asked my mortgage broker, I said, what am I going to be paying per month if I only put down 10% on my home here, the one I'm living in right now and streaming this from? And it was like $70 a month or something for PMI. So I was like, okay, I either come out, I think this house was 350 or something $1,000. I either come out of pocket 35 grand additional, sell some stock, do this, do that. So I either find another $35,000 to put down 20%, or I just put down 10%. And I said, okay, well, we'll put down 20%, give me a better interest rate. No. Well, what's the only benefit? You don't have to pay the $72 a month or whatever like that. Okay. So it just happenstance that, you know, I just, you know, not super aggressively, but every couple months I'll throw an extra $1,000 at the mortgage, which is probably stupid because, I mean, let's be real, comparatively to my mortgage rate, you know, it would have been better in the stock market, but still, you know, I want to just get it to the point where I have some decent equity. And eventually when I refinance, if I ever want to rent this place, I want to get the mortgage as low as possible so I can cash flow, etc. So anyway, I hit that point of 20% on this house. I have a different story for a different house, but for this house, particularly, I hit that 20% threshold. And immediately just called them up. I said, hey, I'm at an 80% loan to value ratio. I think I paid like an extra $1,000 like a couple months back. And I was like, hey, I know for a fact that puts me below 80% loan to value. Like, let me call them up. They say, email this. It was like private mortgage at Citizens Bank or whatever. And emailed them. I said, hey, I'm officially below, gave them my mortgage number, address, etc. And within a week, I had a note in my mail saying PMI has been removed. Your new payment is X. I logged into my account where I pay my mortgage, and it's all at escrow. Saw that it no longer they're going to be charging for mortgage payments. So that was as easy it was because I just started paying an extra couple $100 a month on this house. The other home, we haven't been paying extra. That's one of the
wait. But before you continue, do you have to pay? Do you have to do you have to get a reappraised, right?
No.
Like the appraisal. Really?
I didn't do any reappraisal. I'm about to tell you a story that's different, right? So that was just, I didn't do a reappraisal. This is literally just like, hey, I've been paying the house, like, I'm an 80% loan to value of the original home price that I bought this for. I don't want to get it reappraised, nothing like that. I just have paid what I bought the original house at. I have now paid and gotten a 20%. I guess I think if it was like more than a couple, like I forget, it was like more than 3 or 5 years or something like that, maybe I would have had to pay for an appraisal, but no harm, no foul. The one I just did last month was part of the reason why I was up in New Jersey. One, we were putting in a pool at the rental, but another one was because we put down 10% on that in 2022. We did another thing. It was like, okay, we're going to be renting it. It's a gamble. Like, instead of putting in like however much money, we only want to put down 10%. Let's do that. They let us do it. Once again, it was like, are we going to get a better interest rate? No. Okay. Then the only thing that's different was we would have to pay $90 a month in PMI. It's like, well, instead of coming out of pocket an additional X amount of dollars, I'd rather just pay the $90 a month, which has been good, right? Because you think about it, I've kept that money in the market and I've done well with my investments in the stock market, right? So people always say, Matt, you're an idiot. You should always put down 20%. Well, both in 2023, when I bought this house, and 2022, I didn't put down 20%. And obviously I've done pretty well with Palantir, Rocket Lab, a couple of my other stocks, right? So I've come out fortunate in that respect. So in that house, we have not been paying extra. So we're only, I think, paid off like an additional $5,000 or so in equity in that home. But we bought it in December 2022, and we know for a fact that's a good appreciating area. 2 bedrooms are selling for what we paid for that 3-bedroom, 2-bath 3 years ago or so. So we were like, you know what? Like, let's pay the $400 out of pocket, reappraise it. And with that, then we can basically get the removal of the private mortgage insurance. And so all they did is they said, hey, call these people, have them appraise the house. The appraiser comes, they look at the house, they say, okay, the house value is X, which is now, X amount higher, 15% higher than when we bought it. And now, of course, it being 15% higher, that puts us at a loan to value ratio, or equity ratio rather. Our loan is only X, but now we've gained equity because the home value is more, of less than 80%. And so now we don't have to pay private mortgage insurance on that either. So just like that, I've removed one on a rental property, which was $90 something a month. And then one here, which was $70 some a month.
Nice.
So some small wins there, but if anybody's never done that before, that's that.
Yeah. I think after 5 years, man, most people should at least look into doing something like what you just said, because their homes probably have appreciated well beyond the down payment, especially if you put down less than 20%. I don't know too many people these days that put down 20%. Like, it's just, number one, it's really hard to find that kind of liquidity among most people, especially if you're buying a home in certain areas. Like, I'm looking here in Atlanta, bro, almost every home is above 750 to 800K. Now the thing is, like, that requires almost 160,000 in cash. And the thing with me is that, like, I'm like, I have the money, but I don't want to lock it away. I could get a much better return than putting that money in towards a down payment. And now that capital is locked away into that house. So my thing is, hey, I'm going to try to put in the least amount that I can. But the thing is, if the home price appreciates, over time, I'm not in the business of paying PMI that I don't have to, right? So yeah, I think after 5 years. So if you've bought your home and it's been 5 years, I think it might not be a bad idea to actually reach out to your mortgage servicer and say, hey, listen, my current home is worth X, and I may still be paying PMI, and get rid of it. And I don't think the banks ever come to you and say, hey, guess what, Matt? You don't have to pay PMI anymore. Your home is worth more. Like, they'll never do that. You actually have to go out there and search for stuff like that.
You got to chase them, yeah.
Yeah. And the thing is, like, it may seem like a small trivial amount, $70 here, right? And it's like, yeah, but that's $70 that you don't have to pay per month. Multiply that by 12, right? That's almost like 800 and what is it? 12. Yeah, it's like 800 something dollars, man. Use that $800 towards a nice little like weekend getaway with the wife.
Yeah, I mean, with the I mean, you think about it, it's almost $1,100 for the Airbnb. It's like that's straight cash flow back into our pocket. Like we could either use that to reinvest back in, pay for hot tub maintenance, pay for pool maintenance now that we have the pool. Like, I mean, the pool upkeep annually is gonna cost a couple grand to open, close, maintain it during the summer, and same thing with the hot tub. So that goes to paying that off. So between now and my other thought process is like, yeah, maybe you don't want to come out of pocket if you're just going to refinance the house, because obviously you're going to refinance the house, then you get a reappraisal with that anyway. But for me, I wasn't 100% certain what the Fed is going to do. So my thought process was like, for the $90 a month, it was like $350 or something for the appraisal. I was like, I break even in 4 months. So I was like, I'd rather take that gamble. And it's like, if I do reappraise the house, like, and get it refinanced, like, that's fine. But I was like, what if something happens and they don't cut rates until the end of 2026, and I'm sitting there the whole year spending $90 a month, $90 a month, $90 a month. And I'm like, shit, I should have just done it. And I wanted to do it earlier this year, but we dragged our feet for some reason. I don't know why.
Yeah.
But I think my partner couldn't get down there until September. I think that was it. I think I wanted to do it in like May or June. So we technically lost out on a couple months, but
at what point do you think you're going to refinance? Like, what would be the interest rate that would get you off the sideline and say, you know what, it's worth it to pay the what do they call the fees for the when you do all the refinancing? Like, I forgot what the fee, the closing cost for refinance. So at what point do you think it would be worth it for you to do that? Like, in terms of like interest rate?
I've just made amortization tables. So what I generally do is I kind of estimate and look at like what my remaining loan would be. And then you recognize that when you refinance, you start at 30 years again, unless you're doing 15-year mortgages. So you kind of have to recognize, it's like, okay, well, what is it to start at, start over again from scratch, at 30 years and, at a lower interest rate. And I guess you just have to decide whether or not that's worthwhile to you or not. So for me, it really started to make sense. Anything that's more than like a full percentage point interest rate, I think, has been making sense to me. So it really just depends. Like, you're kind of gambling, right? Like I almost wanted to do it last year in September, as you showed earlier. We had that dip in September, and unfortunately, I thought that we were going to continue to cut, and we didn't. Right? We ended up kind of going back up and going above 7% interest rates again. And my hope was that we were going to continue to go down then, and my hope was that we would kind of get into the low fives. My target's kind of low fives. So I think at that point, my thought process is we're never going to get to the threes again unless something drastic happens, right? So my thought process is like, I want to be as close to the low fives as I can get, because my fear is that if I wait till the low fours, it might not ever happen, and I'll end up in a situation where I never end up refinancing, and I'm just waiting forever. So my thought process is I'd rather just refinance at the low fives, lock something in. And like, I've just done the math, like refinancing on like a lot of the properties, you're talking about 7 figures worth of mortgages at this point, across everything. So you think about that on an annual basis. I mean, you're talking about a pretty good chunk of change in terms of annual interest costs, if you were to just cut a couple percentage points. So anyway, that's kind of my hope, is that we're able to kind of get into the mid to low fives for a lot of these things.
Yeah,
But yeah, it really starts to make sense after about a 1% change in interest rate.
It might not be a bad idea to start looking at companies like this that have the ability, who basically make money using PMI. So this is like private mortgage insurance. PE on this thing is like 7, right? They're buying back shares. So let me just bring it up. But you have to be very careful with this. There's like certain things that I have to do a lot more research with, but you can see their net income has pretty much gone pretty solid up. And it's only a $2 billion market cap company right now. And then if you look at their cash flows are very healthy. So cash from operating activities, right here is almost 390 million. So we have to do some research, but I think this could be an industry that's going to have a tailwind of refinancing. So a lot of times what happens is you've got these businesses, they are in the business of origination and servicing and all this other stuff. And so, this is where, like I said, we'll talk about it offline, but this is something that we could put into the portfolio next year if we start to see the Fed really accelerating their rate cuts, in which case now a lot of people like yourself are probably going to want to refinance, in which case that means that mortgage servicing is, that whole thing is going to end up working well. Man, they don't have a slide presentation here. What's going on?
But I don't think it's so. I mean, we talked a lot about mortgages and everything today. I mean, I think in housing, I don't think this is going to be isolated specifically to houses, though. I mean, we've already started to see things like nuclear, quantum start to get hit. We've started to see gold take a hit today. So we kind of went on a tangent about what you wanted to originally kind of talk about. So maybe the last 10, 15 minutes, we can kind of touch on that. But before we dive into that, maybe let's take a quick look at a video specifically around gold, because I'm kind of curious what the heck happened, because I didn't have the chance to follow up on it today.
Yeah. Meanwhile, recently, red hot gold pulling back in a big way today. Prices settling down nearly 6% for their worst day since 2013, April to be specific. The precious metal hit its 49th record of the year just yesterday, and even with today's pullback, is up 56% this year. We're just back to, I think, last Monday, basically. Yeah. The gold miner ETF down more than 9%, its worst day since 2020. So what about this hiccup?
The gold mining makes sense 100% in terms of being twice as bad as the underlying commodity. We've seen that before because people are now terrified that the gold move is over. We had talked about recently, the RSIs were historic levels north of 90%. I mean, the overbought conditions, again, were historic on a number of different metrics. So this was coming at some point. Now, I thought it was coming in the form of an equity market sell-off where all risk assets would go lower. That obviously is not the case today. So something else was going on. I'm not exactly sure if maybe people got out of gold into Bitcoin. I will say it again. This is not over by any stretch. This is a healthy pause and a move that I think will continue over the months to come.
Yeah, I agree with that. HSBC and Goldman Sachs still have a $4,600 to $5,000 price range or price target for gold in 2026. I think it will go higher. But think about where we are seasonality-wise. First of all, everything that guy said, we ran up, probably should take a stutter step back. November, December, positive months for the equity market, pretty bullish months. Maybe, just maybe, people want to get out of that and get into equities. Maybe they want to get out of that and get into Bitcoin, as Guy said. So there's a host of things to do with it. I think that eventually, if it holds 4,000, 3,800, you're going to rip back to 5,000 probably in the next year.
I wouldn't get too far from gold, but the truth of the matter is, like, we talk about this being a store of value and a place where you park cash when you have looming concerns about either the U.S. economy or general geopolitics globally. And the speculative nature that we see in all these other high growth, high beta pockets of the market found itself creeping into the gold market. And so naturally, you're going to have some pullbacks and some sideways trading. So I think Carter called the top almost to the date. I think that's great. I think you continue to monitor the technicals. But again, I don't think there's a situation where you should dip completely out of gold. But I would look at perhaps when you re-engage, allocating some to copper and some to gold.
Silver also.
Same thing. I mean, now and Carter had his chart showing that silver basically topped out exactly where it did historically. And then he showed it adjusted for inflation, nowhere near where it was on a historical basis. But if gold moves the way it did, silver's going to move the same way and probably twice as bad, which is the move we saw. It all, in retrospect, it all makes sense. I didn't think it was happening today. I don't know what the trigger was, but here we are.
Mr. Patel, do you think that this is all correlated to what's going on in some of these other speculative names, or do you think it's completely disparate comparatively to what's going on with nuclear, quantum, or things like that? Or do you think people are taking money off the table, focusing on just buying into other equities, more safe equities, or focusing back into AI, something that's a little bit more tangible?
I think it's just the market is being a little bit more risk off with things that have accelerated really out of the normal pace. And so one of the things that you saw, and this is what I posted on X, I think last week you started to see lines in Asian countries, like especially China, people lining outside their local gold, I guess their gold bullion houses to buy gold. And so, you know, a lot of times whenever these people, they get this thing in their head, like, oh, I just need to buy gold, it gets insane, you know, and they're willing to pay a price that's way beyond what the norm is. And I think for the most part, one of the reasons why we've seen this upward rise in gold is not because the retail consumers have been buying so much gold, but it's because a lot of the central banks, they're fearing the dollar debasement trade. And so they've been loading up on gold instead. They're saying, look, if the dollar is going to continue to weaken, and the administration is kind of already said that debasement was one of the goals that they had, you know, via their tariff measures and everything else. I mean, the administration came out, Trump said the dollar is too strong, right? And so one of the ways that I guess he interpreted the dollar being too strong is because the dollar is too strong, people are ripping us off, manipulating their currency to keep it low so that their imports into the US are cheaper and our exports to them are more expensive. So his thing is, if I devalue the dollar, which he's done, like the dollar is down 10%, Dixie's down 10% from where it was when he took over. That means that people are going to say, well, I trust the dollar less. I trust the gold more, you know, so a lot of people are buying gold, especially a lot of central banks. So central banks are buying up gold, and that's taking away from supply. But long term, if you look at how gold is priced, it's supply and demand. There's a lot of deposits of gold around the planet right now that are out of reach if gold is at $1,000, $2,000 an ounce. But at $4,000, they become very interesting. Like there's pockets in Alaska where, you know, where there's gold a lot in a lot of places that you could get. But the thing is that cost of getting the gold is rather expensive because you have to go all the way into the frozen tundras, and there's parts in Africa that's the same thing. But if the price of gold keeps going up, the amount of money that goes in towards getting the gold out goes up with it. And so you'll actually get more supply. So the question is, are central banks now kind of pulling back from buying additional gold? Because if they're pulling back from buying additional gold, then, you know, supply of gold might increase while at the same time demand slows down, in which case now you'll see what we saw.
Well, you did hit the nail on the head. Gold Rush is one of my favorite TV shows.
Dude, I love Gold Rush.
Yeah, Gold Rush is phenomenal. But yeah, this is one of those things that we wanted to talk about a little bit today with respect to deglobalization and what's kind of going on in the world. So let's just watch this short 4-minute clip And then I want to hear your thoughts because this is something that you wanted to dive into for today.
Joining us now is Sir William Browder, founder and CEO of Hermitage Capital Management and head of the Global Magnitsky Justice Campaign. Bill, it's great to have you on the show. Welcome.
Great to be here.
So that's exactly where I want to start with you, because not a day, and if not a day, then not a week goes by that I'm not speaking to CEOs both on and off camera who don't say that, or do say, I guess, that that geopolitics is among the risks that they're tracking most closely right now. So just want to get your thoughts on the geopolitical landscape, especially as we do see a possible second summit between Trump and Putin collapse here.
Well, I mean, basically, geopolitics, I think, are probably the single biggest risk for all investors right now. You have the war in Ukraine. You have this huge fight with China over tariffs. In the longer term, you have the question of whether China is going to take over Taiwan. And then you have all this issue about the United States falling out with traditional allies and what that might do for the U.S. dollar's reserve currency status. When you put this all together, it creates kind of a treacherous backdrop. Normally, investors just focus on their business and their relatively narrow set of interests and try to ignore what's going on broadly. But I don't think you can do that right now.
So what do investors and also corporate America and C-suite executives need to understand about what it's going to take to bring this war in Ukraine to an end?
Well, I think that the main thing everyone needs to understand is that the war is not going to come to an end. And the reason it's not going to come to an end is that the person who launched this war, Vladimir Putin, doesn't want it to come to an end. The reason he doesn't want it to come to an end is that he has put this war into motion, not because of any specific beef he has with Ukraine. He's done this war because he is worried after 25 years of being a dictator in power that his people may come to get him, that there will be 1 million people marching on Red Square. And the best way to avoid angry Russians angry at their leader is Machiavelli 101, create a foreign enemy and start a war. And that's what the war in Ukraine is all about. And very few of the political leaders understand that. And so when you're hearing about President Trump's conversations with Putin and offering up this and offering up that, the simple answer is that Putin doesn't want any of those offers because Trump can't offer him the thing that he most needs, which is guaranteeing that he'll stay in power. That's not something within Donald Trump's control. And so all this stuff is just sort of dancing around the head of a needle. And I'm afraid that all these headlines that we read lead to nothing. And so everybody needs to kind of prepare themselves that this war is going to go on for a while.
Last year, there was a focus on American-made weapon systems like F-16s being delivered to Ukraine. Right now, there's a lot of talk about Tomahawk missiles being included on the battlefield as well. But I do wonder if the leverage to bring this war to an end actually lies in the energy market. And if so, your thoughts on that, as long as Russia is supplying certain countries with oil and gas.
Well, I think that there's two keys to ending this war. And one is, as you mentioned, the weapons that Ukraine needs to hit Russia hard in their refineries and their military bases, et cetera. And the other is that the Russia has one huge source of income, and that is the sale of crude oil. Since the war started, Russia has sold $400 billion of crude oil to China, India, and Turkey. And if we really wanted this war to end, what we would do is to identify the 8 refineries, 2 in China, 4 in India, 2 in Turkey, that buy all the Russian oil. There's only 8 refineries in the world that are giving Russia this $400 billion. And we think of those refineries is either us or Russia. You can either do business with the West, buy from us, bank with us, sell to us, or you can do business with Russia with their discounted oil. Your choice.
Yeah.
And I think if we made that ultimatum to those refineries, they would say, we'd rather do business with the West. And if that happened, the oil would still get out there somehow, but it would be selling at $20 a barrel, not $60. And in 6 months' time, Putin would be on his knees begging for a ceasefire to end this war.
So what do you think, Mr. Patel? I mean, we started to see the need or want to get away from Taiwan because of the issues going on with the Chinese and Taiwan standoff that we always continue to see. We've obviously been at odds with Russia since the 2020 2022 Ukraine-Russia war getting started. India is obviously not wanting to play sides, but they're obviously buying oil from Russia because they're right there. China and Russia are both in cahoots with each other and siding very, very closely with each other during all this. South Africa is obviously on their side as well. So just kind of curious what your thoughts are. I mean, do you think that really the United States and the petrodollar are at risk, knowing that China is selling a lot of their or buying a lot of their oil in the yuan and many other things that are going on that is really challenging the dollar as the world's kind of global currency? And then also, I mean, do you think that the NVIDIA taking a step back out of China is obviously going to cause issues, and just this whole issue with not wanting to sell into China whatsoever for U.S. companies is going to cause issues due to the reverse engineering aspect of things. Also, there's the political aspect of it, of just being on the bogey, not wanting to interfere with the current administration and not wanting to upset them. A lot there, but just wanted to hear your thoughts on all of it.
So let me just start by saying, first and foremost, I am a U.S. citizen. Okay, I love this country to death. I will always support this country, even if, and my cousins, we always have this debate. They're like, oh, if India ever invaded America for whatever reason, who would you fight for? And I told them I'd fight for the U.S. because I'm an American citizen. That's the thing.
And you did fight for the U.S.
Yeah, but there's one thing that the U.S. needs to acknowledge, and that is that they have been on the wrong side of history a lot. And because they've been on the wrong side of history, a lot of those demons are coming back to haunt the US. And we can piece it together, different things. So number one, China, they made a really big blunder in that they really opened up a lot with China. China was very aspirational to become part of the world stage, and the U.S. basically said, well, we can turn them into a democracy by giving them all sorts of privileges in the World Trade Organization, and then you had globalization, and the Chinese ran with it, and you basically created a monster, right? So that's number one. So now the Chinese are like, look, we don't care about the U.S. Like we're our own economy. Then you have India. India is a growing democracy, and they have a lot more political allegiances to the U.S. in terms of, like, we both are democratic countries. We have populations that are very tolerant for the most part. I'm not saying 100%, but very tolerant of other people. But the U.S. had picked a lot of sides, and a lot of times between conflict between India and Pakistan, the U.S. chose Pakistan and the Russians chose India. People in India have very long memories. They won't ever forget 1971. Pakistan was having issues with their other part of Pakistan, east and west. And basically there was atrocities happening in Bangladesh. And India ended up getting a whole bunch of refugees, and India took some action against it. And Pakistan invaded India. And basically the U.S. said, oh, Pakistan, we got your back. And they sent, like, I think a fleet, like a Navy fleet, into the Bay of Bengal with what is the thing called, with the British, I think some of the other things. And at the time, Indira Gandhi, she reached out to the Russians, and the Russians, they sent a nuclear task force to basically quell the whole thing from escalating. So that whole thing, the Indians will never forget. And the Indians, they'll always remember that fact. And because of that, right now, the U.S. has been known to be one of the worst in terms of arms suppliers, where every time that they've given weapons, it's been on a conditional basis. So you cannot buy stuff from the U.S. The U.S. is a terrible, terrible ally. Even Henry Kissinger used to say, like,
all right, I don't want to be that guy, but how is this going to relate to the economy?
No, I'll tell you. So to get India to not buy Russian oil is impossible. Like, trying to cut the Russians off from the world economy from oil is not going to happen. So is the dollar petrol challenge? Yeah, absolutely. If you think the Indians are going to stop, they're not going to stop. If you think the Chinese are going to stop, they're not going to stop. And the Europeans, The Europeans have not done enough to diversify their own energy stream. So you think all the Indians are refining all that oil? Where's that oil going? India is using some of it for domestic, but it's all going to Europe. That's why the US is pissed off. The Europeans are funding the Russians. The Europeans are still buying natural gas from the Russians.
You're saying that India is refining oil and then exporting it to Europe?
Yep. Everyone knows that. Everyone knows that it's not even a question. You can actually see the refined products going, like literally the Russian oil tankers are going to India. India is refining it and then sending the finished products to the EU.
I've been too focused on LNG. I think that
I know.
I've been focusing on that.
No, I'm telling you, the US has actually been really adamant on India stopping this bullshit. India is making money off the war. India is making money off of this war. Everyone knows it, So,
well, I know for a fact that we've definitely been trying to have them cease buying product from Russia for certain. But them actually refining and exporting. I've been more so focused on Middle Eastern supply going to Europe and natural gas going from the Gulf Coast to Europe. I haven't really been focusing on refined products from India as much.
Yeah, if you look at India's refined products, like even President Trump called him out and said, "Look, you guys are playing this thing. It's 1 second, right here. Trump, India squeezed to put Russian oil further into the shadows, but basically right here, India bought 40% of Russian crude. India does not need 40% coming from Russia, okay? But once again, they've been refining it and sending it to Europe. Where is it? Just
there you go. Yeah, Europe accounts
right
for
here.
a third of India's diesel exports.
So on one side, the Europeans are like, hey, we're anti-war, but on one side, they're still buying oil and not oil, they're buying refined products from India. They're still buying LNG and from the Russians. So, until the Europeans, they stop buying from them and buy from, let's say, the US and the Middle East only, I'm sorry, the war is going to go on. The Europeans are funding the war. And then the US is also kind of like in a really bad bind because they've cut off the other two major suppliers of oil around the world, Venezuela and Iran, right? Iranian production is capped by sanctions by the US. Same thing with the Venezuelans. So the only option you really have is the Russians at this point. So it's a very delicate balance on how things are. But yes, the Europeans, they didn't invest enough in diversifying away from the Russians, and which Trump was right. Trump was, dude, in 2017, I think when he was at the NATO conference, he called the Europeans out. He said, listen, there's no way you guys are sitting here buying all this Russian LNG, Russian oil, and then saying that, hey, the US, we have to protect you. Like, come on. So
no, I still think that there's a lot of, specifically in the North Sea, there's a lot of remaining value and resource to be extracted, and unfortunately it's just not in the political and regulatory landscape to make it worth it financially, and that's all I'll say about that. But
yeah, no, it's funny in the comment section, someone's like, I'm not surprised that India's buying oil from Russia. I am surprised that the Europeans are buying refined products from India. Yeah. Trust me, I was shocked by it too, but that's how things are, man. So
yeah, but I mean, with respect to everything else, I mean, you made it seem like that there's going to be a large amount of macroeconomic impacts because of deglobalization. I mean, what specifically did he mean by wanting to touch on that?
Okay, so this is something and this is the thing that I wanted to add with the new prime minister of Japan. I'm sorry, I don't remember her name. It's Japanese. It's hard to remember. I'm sorry. I should look it up. But a lot of the new politicians that are coming to power, not in just the U.S., but a lot around the world, have very nationalist leanings, right? So their goal is, hey, we need to protect our borders. We need to be a lot more. We need to have economic policies that are geared towards supporting our local populations. We can't just have every job being exported out of the country, right, and then sent to the third world countries to produce stuff. And then we can't have at the same time this mass migration come into our country and basically dilute the workforce. So you're basically causing a great amount of strain on the local populace. So a lot of people are coming to power that have a more nationalist message where it's like, hey, we need to, throw off the shackles of globalization, which means that we need to produce things domestically, right? So domestic production, and at the same time, you also have less inbound migration from other countries. So when you have that kind of like new policy that's coming along, it's anyone's guess as to how things are going to end up in the next like 10, 15 years. So with the US, we've got Donald Trump, who's definitely like a nationalist, now is willing to put up the trade barriers via the tariffs and everything else. But now you've got Japan. Japan is in the same boat now. You've got a nationalist as a prime minister who's, more about, hey, we don't want foreigners in the country. We want to be on the global stage, but we also don't want to basically like give up our Japanese identity. You're starting to see this happening in Europe, where a lot of the more nationalist, what do they call it, politicians starting to make waves, like Nigel Farage over in the UK, Geert Wilders in I think Denmark, Marine Le Pen in France. So a lot of the decisions that were made politically over the last like 30 years, they've really hurt a lot of people in those countries, especially the youth. So if you look at the hopefulness of a lot of the youth in a lot of those countries, they're at like all-time lows. The people don't feel like they can own homes. They don't feel like they can have kids. They're not getting married at the same rates that people were getting at like 20, 30 years ago. So that general hopelessness is something that can cause people to vote for disruptors, right? And the disruptors can have a giant impact on how they approach everything from a macroeconomic scale. So the question here is going to be around, where are these leaders going to take their respective economies, and how is that decoupling going to impact, basically trade around the world? I never could have seen tariffs being implemented here in the United States. I think tariffs were just one of those things. They're just like, no, it's a stupid idea. But now that they're in place and a lot of people are accepting of it, I don't think we'll ever get to a point where the tariffs are going away. You think the Democrats are going to come in and say, yeah, let's lower the trade barriers and tariffs and ship more jobs overseas again? They'd lose right away.
Yeah, I still think that there's more to be done more to find out about tariffs. I mean, first surplus that we've had in, I think, since 2015, I think something like that was this last month or something, or the largest one since 2015.
I don't mean to correct you, but
yeah,
every September, there's usually a surplus because of just how the payment system works. Right now, we still have a ballooning deficit, but you are correct in that we are getting a lot of revenue from the tariffs. And the administration has, of course, spoken about using some of those tariffs to pay down debt. But I just want to say that it's not necessarily that we're now all of a sudden in a surplus. It's just that short period we're in a surplus.
Let me see. $91 billion surplus in September.
Mm-hmm.
Yeah. Oh, was that 2015? Yeah, that was 2015. Never mind.
Yeah, that's what I'm saying. That around this time, there's always a surplus. So it's not just it's like, oh my God, like tariffs have made us, the deficit go away. Like, no, the deficit is still massive. It's just this 1 month where the collections happen, we've done okay. We've got more, but that happens every year. So that's why you see like the information, it just spikes all the time.
Yeah, it's a $200 billion surplus in September.
Yeah.
But anyway, so yeah, I'm curious to see what really happens. with respect to with the whole tariff piece, because I don't think that that's. But I mean, I feel like I don't think that this deglobalization thing is anything that's new. I think that this has been ongoing since 2022, when people have really started to put their borders up. I mean, India, I think, was already putting their borders up. China, Russia, because even still, even with this whole Ukraine-Russia war, and everyone's saying, "Oh, well, Russia and China are kind of canoodling together," I still don't think that they're canoodling as much as people think. I still think that Xi is having an arm's distance with respect to Putin, because of wanting to make sure that he doesn't be viewed as someone that's like completely in the pockets of Putin, or vice versa. Because obviously that is a tricky situation, because obviously Russia's under a lot of sanctions. There's going to be a lot of impacts associated with that. And so I think there's just a lot of trickiness associated with that. But you've started to see a lot of people really want to be very much their country first. So even the Europeans have wanted to back away from the United States. Canada's wanted to back away from the United States. Everyone's really starting to look after their own national interests. And I think a lot of this has been since 2022, but also because of the tariff aspect of things, but also with kind of the new administration in the U.S. kind of coming in, and the stance that's been going on. And I think a lot of that is because, regardless of whoever is in power, the United States is looking after more of their own interests, and was previously, I wouldn't want to say on the dole, but funding more of NATO, being more willing to let Canada take an easier way of trade. And now that we're kind of making them pay up a little bit, it seems like, okay, well, if they don't want to be nice to us, we're going to be slightly hard back. So I think that that's just how everyone's kind of approaching it. And I don't think it's necessarily bad. I think that it's good that people are starting to look after their own interests. I don't necessarily think it's, open borders and being too public and too friendly with one another isn't always good, because that's when you end up having like these like enemies of the state, like somehow being able to infiltrate and be able to kind of sneak their way in and really undermine specific economies and specific governments. So
yeah,
I don't know.
I think the question here is going to be, how is the world going to, if deglobalization is happening, and one of the major impacts of globalization was the dollar becoming like the default currency. That ties right back into our original question that you were asking: what happens to the dollar, right? If you're trying to decouple away from everyone else, are you still going to want to be coupled to the dollar system, or are you going to try to do other things? And that explains your gold price. There you go. So it's like, oh, do I want to keep buying into dollar? No, maybe I'll buy some gold. And guess what? Everyone accepts gold. Tell me one country that wouldn't, like one people that don't accept gold. No, people accept gold. So right now, the US, the Russians used to keep a lot of their reserves like in banks in Europe. The war happened. What happened to the Russian deposits? They seized it through the SWIFT system, right? Do you think the Russians are going to be like, yeah, let's go back into the dollar again? Like, no, they're going to say, freaking gold is where we want to be. They're Chinese. Are going to do the same thing. Mm-hmm. So you don't want to get cut off from the rest of the world's economy. So what do? You go into assets that are alternative. So, in that case, now the dollar weakens and you have alternatives starting to rise. That's why you see Bitcoin as a grower. You got Ethereum now that could theoretically become a default issuer for stable coins, and the stable coins could end up becoming a giant what is that thing called? A giant purchaser of U.S. treasuries. So I don't know. The Trump administration has definitely put like the whole global order in a very difficult place. Some of it was probably necessary. Some of it might have been a little bit too much, but I think we won't know the impacts of all of this until probably like 10, 15 years from now. And the U.S. may not be the global hegemon anymore, and maybe that's a good thing.
I mean, I think current thought processes right now is that China with the current trajectory, their GDP growth is supposed to surpass us in the early 2030s in terms of being the number one power in terms of GDP, right? But that was a year or two ago. I haven't really observed it since everything that's gone on with AI and how that has impacted our GDP growth. And to be very fair, our GDP growth has grown at a much faster pace over the past several quarters than I was previously expecting it to. So I'm curious if that maybe has been adjusted to maybe middle of 2030s, if not beyond the middle of 2030s into the late 2030s, that China eventually surpasses us in terms of the largest GDP, if at all. But yeah, I don't know. You think about it, initially I was thinking, how could you actually debase? So many people utilize so many American companies. Like you have the Metas of the world, the Googles of the world. Like you have almost all this global revenue that comes in. And so people always talk about, it's like, oh, I need diversification. It's like diversification from the dollar or diversification in terms of global exposure. And that's always kind of a piece that I always kind of run in my head, because people are always like, well, you can't just invest in American companies. It's like, well, they're not American companies. They're American based companies, but they're all global companies. So when you say that, like, are you saying you need international exposure? Because when you have AWS, like people were complaining about AWS being down in UK just as much as they were talking about being down in the US yesterday, right? So
Was it? I thought it was only impacted like the AWS East, like the US East.
I heard people in the UK saying something about it too. No, maybe I'm making stuff up in my head. I don't know.
Because the data centers, because it wasn't all of AWS. It was just the ones that are in the East. I don't know. Like I don't know either. I thought it only impacted us here in the East Coast. Because remember they have different regions where AWS is running, right? So, like I said, no, the data center, that's stuff all over the globe. No, that data has stuff all over. Maybe it's happened. Yeah.
But yeah. Anyway, so yeah. Interesting. Yeah, it's there's a lot to digest. There's a lot of going on in the world right now. I'm still curious to see what happens with this pullback and some of these more speculative names. I don't necessarily know if it's going to be the demise of them, or if it's just a breather. But as always, I just want people to be sure that, if they've thought about jumping into them,
Matty, are you
use
shorting
caution.
Quantum? Are you shorting Quantum? I'm shorting Quantum, baby. I am short. Well, I did it through the double XL QBTZ, bro. It's up 85% this week. Look at this.
That's why they pay the big bucks, man.
Dude, this was one of the best hedges that I bought this week. I was like, dude, Quantum is just, I don't know. I'm thinking about just closing a little bit of it, or should I let it ride? I don't know. Every morning I've been waking up like, all right, where's Quantum doing today? And it's just like, so yeah.
I mean, I feel like that has a natural drift downwards anyway, because it's, yeah, I don't know. That's tough.
No, because it's, dude, these are pre-revenue companies with no cash for the next like 5 years. I don't even know if in 5 years they're going to be able to generate any real material revenue. So I think right now the market is slowly correcting. I don't know. Okay, here's a legit question for us before we go. Do you think the Trump administration is manipulating the markets?
I think they're doing what they believe is in best interest of the economy, which I don't necessarily think they're saying like, how can we make like, there are some things, how do I say this? There are some things that I believe that they are doing to help some of their individual friends make money, like some of the SPACs that they're doing, some of the cryptocurrencies, etc. But I don't think they wake up in the morning and be like, how can we fucking make the S&P drop by 1,000 points so that we can make everybody buy in America and make it go up in 6 months. I think they're just literally acting in best interest of what they think is the best thing to do for the economy, what they think.
Mm-hmm.
And I think that they're reacting verbally to how they see the stock market. I mean, I don't know. I read it like a book back in April. I mean, I don't want to be that guy, but everybody and their mom was like, markets are going to zero. And I'm just like, calm the fuck down. Like, I don't want to be that guy, but I was just like, it's going to reverse. Like, just calm down. In 6 months, this will be, I would love to pull up some of our streams. Like, maybe I'll do some homework between now and Thursday, but like, I didn't sell anything. If anything, I adjusted some things to be able to take advantage of. But there was no panic. In fact, I was excited because it allowed me to buy more Rocket Lab. It allowed me to buy. So, I don't know. There was just a lot of people at the time but anyway, like, I don't think that they were intentionally trying to be like, oh, let's tank the market by, 150 or 1,500 points. I just think they were just doing the tariffs and stuff that they were talking about. They talked about tariffs the whole time. He's been talking about tariffs since the 90s.
The first admin.
Yeah.
I mean, well, yeah, you're right. Since the 90s, but he actually implemented the first tariff policy in his first term. Oh.
Yeah. So, I mean, it's not like he's sitting there being, you know what I mean? Like, all of a sudden tariffs are coming out of nowhere to try to tank the economy. So I don't know. Maybe that's a biased view. Call me MAGA Matt. Everyone on X does. But
I was funny. I said that did someone teach Trump how to do 0-day options? Because a lot of his tweets, they seem to be around like 3 o'clock, right? So it's like the markets are like ripping higher, and then he's like, "Oh, my covered calls are gonna get there in the money," and then he's just like makes like one phone call or one tweet, and the fucking market.
He's got Barron just managing something for him. Yeah.
Yeah. It's like,
yeah, there you go,
father. Dump it, father.
There you go. I don't know. But yeah, I think, I guess all this stuff, I think, is very just dependent upon what people's time horizons are, right? Like, it's fun to talk about, but at the same time, it's in a couple of years' time, like, just buy the companies that you want to buy through the cycle. Like, every time I always just get more and more convicted. Just buy through the cycle, buy through the cycle, buy through the cycle. Find companies that you want to buy, and when the price gets cheap, add more to it. When it's less cheap, still buy, but just don't buy as much. Like, I don't know. It's I think people overcomplicate it. I think they try to be smarter than they are, and they overcomplicate it, and then they get frustrated, and then they get emotional, and then they make rash decisions, and then they make the wrong moves.
Jesus, man. Even overnight, quantum is taking a dump. This is bad. This is bad.
So yeah, maybe you trim some tomorrow.
Yeah, it might not be a bad idea. I don't know. I think that we might actually start to see rotation into value. People might actually say, you know what, I need to get out of high beta. I need to be in more value. Healthcare was up nicely today. Oscar was up almost 7% today. UNH was up during the day, but then it kind of came down to 360s. Let's see. BMNR has been crypto has been taking a little bit of a break. I've been selling puts on BMNR. I've been lucky that I haven't got any assigned to me yet, but
what are you doing with that capital? Just income, or are you putting that into more BMNR, or?
No, I'm just putting it into like different things. I'm just putting money on the side right now. Like I said, like my current play is the Verizon thing, but like I'm managing that Verizon play very cautiously because there are some data points that I wouldn't say are worrying, but it's just something to keep in mind. And so sometimes what happens is in the short term, businesses have to make some decisions that might cause the stock to kind of, just be down a little bit in the short term, but long term, they're good for the company. And if you just know how the business operates, it makes sense. Like, so right now, I'll give you an example. Verizon, they have been raising prices, cutting back on discounts on a lot of plans, and so their revenue has started to reaccelerate, right, as they cut back and they've still been selling. So their cash flows have been growing. The problem is, if you look at their subscriber base for their wireless postpaid, they're losing market share to T-Mobile. So in the short term, it's fine. You can raise prices, but the problem is, if your consumers are leaving you, then you got a problem. And so the CEO bounced on them. Well, I mean, he didn't bounce. He pretty much got fired. And I think the new CEO is coming in, and I was looking at some of the promotional materials. It seems like they're going hard on trying to either maintain market share or try to regain some of it. And usually when you try to do that, you usually have to spend more money on marketing, you have to spend more money on promotional deals, in which case now you'll kind of erode your margin a little bit. So the question then becomes, okay, what is guidance going to look like for next year? So if you were projecting 12% margin and all of a sudden now you've got to spend more and you're taking a 200 basis point hit in the short term for additional marketing and promotion, right? You're gonna go down to 10, so your earnings have to kind of adjust. And so if you play it smart before earnings, you can at least hedge against a move down. So the question now is, with Verizon, it's already down from 45 down to 40. It actually went down all the way 39. Is that move already kind of baked into the sauce? It's only trading at like a 9 PE right now, like 9 point, and I think on a forward basis it's even less. So the question is the market already pricing it in, or is there still a lot more room to go? So yeah, and someone said it, T-Mobile is going to start a price war. See, that's the other thing. Now you have companies that are going to be impacted by the deportations too, like what do they call cell phone plans? Verizon, T-Mobile, AT&T. I mean, you deport 2 million people. You're taking away 2 million postpaid, the possibility of 2 million postpaid subscribers, right? So what does that mean?
Sorry to switch us up on you. Somebody said something interesting in the chat about Novo Nordisk. Do you know what the hell's going on with this with respect to the potentially six board members quitting and the chairperson resigning today?
I did not see it. I mean, I saw
tread carefully on the chairperson. You'll see why. But yeah, just curious if keep it strictly to Novo.
So I did see that Marjorie Taylor Greene bought Novo Nordisk. I did not see the board shakeup. So let's see. Novo Nordisk. Where was it? Further announced extraordinary general. The extraordinary general meeting will be held fully electronic according to participation. Okay. What the hell happened? Get the news. Governance dispute. Interesting. Resignations include Vice Chair Henrik Paulson, take effect. The company said the board members will not stand for re-election. The dispute centered around differing views about the pace and scope of governance changes at Novo Nordisk, seek to maintain its position fast growing. Okay, according to the company, the outgoing board has supported gradual renewal by adding new expertise while preserving continuity, but the Novo Foundation favored a broader overhaul of the board's composition and structure. The plans to nominate former Novo Nordisk chief executive Lars as interim chairman for 2-3 years. It's like a board house coup. It's like Game of Thrones with a pharmaceutical company. Company appointed a new chief executive in August, and now September that will lay off 9,000 employees. Okay, I don't know. I have no idea. I have to read into it and just see like what kind of changes that they were asking for and what happened. I was, like I said, I've been focusing a lot more on Verizon and like the ouster of Hans Vestberg. But this is the part that actually is kind of funny. Do you know who the chair of Verizon is? The chairman of the board?
No, do not.
It's the CEO of Oscar,
Ah, okay. Interesting.
Mike Bertolini. So Mike Bertolini is the chair. He was on the board, so he got put up to chief exec. To, what is that thing called? To chairman of the board.
Chairman.
And then they nominated Daniel Schulman as he was on the board too as interim. See, the thing is he's CEO, but I think he's more like interim CEO, even though he's 67. Like he's not trying to work for the rest of his life, dude.
Yeah, it's a little older.
I know. So I think he's gonna be like a stand-in until some of these other people. And then they got this guy who's a complete idiot. I don't even know why he's on the board.
Now, what happened to Brown supporting Brown, man? What the hell? Just kidding.
This is the same dude that thought olive oil infused coffee was a good idea. Like, bro, like, just come on, man. Like, no, dumb guy. So Hans Vestberg was the CEO before. So, but yeah, this is the guy, man. The minute I saw his face, I was like, oh my God, not this guy, but whatever.
Interesting. Right. They need to get him off the board.
Yeah, dude, for sure.
Interesting. All right. Well, appreciate you taking the time, man. Yeah, apologies. I didn't necessarily think we were going to chat that much about mortgages, but I think that was a good conversation. So hopefully people got a good enjoyment out of it. It'll be interesting to see where a lot of that goes. And I know for me, I have a lot of mortgages that are above 6.5%. So it'll be good for me to potentially refinance over the coming months. And
by the way, fear and greed is at 25. Are you buying anything
for the whole market?
Or do you think that, well, no, the fear and greed index thing, it's been people usually look at this thing and they're like, oh my God, that means buy the dip all of a sudden.
I mean, I'm always buying. So
yeah,
but I find it hard to believe. Like
we're like 2-3% away from S&P 500 being at all-time highs, and the fear is out there. So some people are sort of saying that like the thing is broken, like it's not there, and I'm like, it doesn't look like it. There's definitely not an April kind of thing, but
I'm always buying, man. I don't know. It's hard for me. I mean, I'm still buying Rocket Lab, still buying Palantir, buying some those oil and gas companies. So
you're still buying Rocket Lab even now?
Yeah.
What's Palantir? It's 181. Okay. Yeah. I might buy the dip on Hood. I think Hood, and I think we should maybe incorporate Hood into the joint portfolio, only because.
What about Webull? What's that? It's still at what, $5 billion?
Yeah. Yeah, 5.5 billion. But I think Hood is going to show a lot of growth in the prediction markets. Like I've been using the prediction markets just to, test it out. And dude, it's so easy. I feel like every degenerate gambler is going to be on either probably using Robinhood / Kalshi, that whole thing. And so you're going to see a big upward revision in revenue for Robinhood, I think.
They're on pace to make $2 billion.
I know.
In net income.
So,
what is what's Hood's PE? I know they're profitable now.
It's 67.
Sorry, I meant Webull. Sorry, that's my fault. I misspoke. I caught myself.
Webull's like some 100 something, but I wouldn't go based on the PE on this one, because remember, they're gravitating from non-profit to profitability, which means that the PE is off. But when it comes to just Hood,
Hood's a trailing 12 month.
Yeah, Hood's PE next year is going to be, they almost generate $2, and they're doing share buybacks. So we'll see what happens. It's going to be, it's not good, but it's like for a company that's growing as fast as they are, I would not expect them to be. I would not expect a low single digit PE. But this year, man, Hood has just gotten big.
Low single digit PE. What do you mean? You lost me.
No, I'm saying for like Robinhood at their growth rate, I would not be like, oh my God, I want to buy. Like I'm waiting for this company's PE to drop to like 10 or 20.
You lost me there, yeah.
Yeah.
No, I'm following now. But what about Webull? What are the other quarters now that they're profitable? I'm kind of curious. Can you pull up W3 Bull?
Yeah.
That's the warrants.
Sorry. The thing is, their financials are not complete on here yet. So they grew revenue 26% year over year on a TTM basis. But once again, they just IPO'd. So there's not enough concrete data to make any determinations on these guys yet. So
net income.
Yeah, sorry. Even Fiscal AI doesn't have like a lot of detailed information on it. Just this is the one thing I need to stop doing. Like I have my personal accounts and I have my corporate account, like my business account. And so a lot of my subscriptions are on my business account, but I'm logged in as my non-business account. Damn it. No, go away. Damn it. Logged into the wrong one. Share screen. So I sometimes have to share the entire screen just to. Okay. Yeah, look at their financials. Their operating profit. Look at that. Crazy, dude. Crazy reversal. And then if you look at outstanding shares, they've been strategically buying back shares whenever they get a chance. So, so it's pretty much been flat. See? So EPS is growing. And like I said, they've got a lot of expansion plans. So as long as they can maintain their growth rate, they should be fine. Yeah.
Sounds good. All right, man. Well, don't do anything I wouldn't do. And appreciate you having me on. And that was an interesting chat. Any thoughts before I play the outro?
I say next year we have to be defensive. Like, I just don't see 2026 being the greatest market ever. What do you think?
Are you talking about short term? Are you thinking about long term? I mean, I always just for the short term portfolio, I'm down to play whatever. But for me, I generally don't give a shit for my personal portfolio. I always try to set myself up for the long term. I don't generally. I mean, I'll do a swing trade here or there, but I don't ever make drastic moves for my own personal portfolio. I just think trying to fondle the soap. I think that there's so much inefficiency. And you end up losing more than you end up gaining by doing so. In my personal thought, so I generally just hold the long term vision.
You're not going to sell any Palantir. You're not going to sell any Palantir.
Why would I?
No, because it's $430 billion market cap company with a 600 PE. You're like, I've been told that since the 20s.
Yeah. No, I mean, it'll come down and I'll be buying more. I mean,
I like that. Brother.
So, I mean, I've actually thought about this, that Robinhood offers such good margin that, like, I don't know why at this point I'll ever need to go to a bank ever again. Like, why, if I ever need to borrow money, why would I go to a bank and be like, please approve me for a mortgage? Like,
Where do you have most of your money in Robinhood, or you have it in Fidelity or some of the other?
Mostly in Fidelity right now, but Fidelity is trying to charge like 10% for margin.
Yeah, margin rates. Yeah, you might as well transfer it to Robinhood and just borrow the money from Robinhood.
So it's like if I ever need to like borrow money, it's like at 5%. Like, why would I ever?
Wait, what's the margin rate on Robinhood? It's only 5%.
Yeah.
Huh.
So it's like if I were to ever like need money for a mortgage or something, and it's probably only going to get better as rates come down. So it's like if I ever were to need money or like to buy a car or something, it's like, why would I go to a bank? Like
under 50,000, it's 5.5. Over 50,000, it's 5.3. From 100,000 to $1 million, it's 5%. Dude, that's lower than a mortgage. You might as well.
That's what I'm saying. It's like, so, yeah, my thought process is like, if I were to ever need to borrow money, it's like, why go through the hassle of, whatchamacallit, going through a bank, having them say, oh, you're approved, not approved, jump through this hoop, jump through that hoop, you know, when I could just borrow for myself. No, I'm not saying we're going to borrow up to like 70% of the loan value or anything like that. But like, if I ever need a down payment or something on something, I could just borrow for myself.
Yeah, I don't think anyone needs to tell Matt to sell covered calls. Matt already knows how to sell covered calls. He goes far out of the money, generates a very small yield, but it works out for him. So
those $100 Rocket Lab covered calls, man.
Yeah. Very nice.
I tried telling my buddy, what was it? It was either for the end of this month or end of next month. I said, dude, $100 covered calls, Rocket Lab. And he was like, oh, I probably wouldn't sell until I got to 100. I was like, dude, the $100 has opened up. And keep in mind, I'm buying Rocket Lab at $3.50, $4. That's where a lot of my shares are. They were offering at one point $100 cover calls for $2.50. So like a lot of the money that I had used to buy some of these shares, I'd be getting back.
Wow.
In a month's time.
Okay.
So I was like trying to tell my buddy, I'm like, dude, and he's like, oh, but like, don't we want to hold it? I'm like, like people just don't understand to an extent. Like, but I hear them. Like, you can obviously get stuck if you get in a situation like Palantir, like where it just continues to run. So,
yeah,
I don't know. It's.
I need to sleep. I need to sleep more, man. I got to figure out my schedule better. Like, I work overnight, and then during the daytime, the markets are open, so it's hard for me to sleep. And then during the afternoons, I do try to sleep, but it's hard. And then, like, I wake up for this, and I'm like, and it takes me at least like 20 minutes. My wife was just like, tell Matt you can't do it today. And I was like, no, man, the show must go on.
Goes on. But no, man, I understand. You guys, you're burning at both ends, and you did one yesterday too. So,
yeah. It's a good times, guys. Good times. All right. Oh, by the way, I'm gonna be in Houston this weekend.
This weekend?
Yeah. Remember I told you the wedding? I'm going to.
Oh shit! I forgot about that.
Yeah, so I'll be in Houston. If you want to grab some dinner or whatever, just let me know. I'll be there Thursday, Friday, Saturday, and I think Monday too. No, I'm not. Maybe not Monday. I think Thursday through Sunday. So I'll let you know.
Man. Yeah.
Grab dinner or something.
It'd be good to see you. Do you know what part of town you're staying in? Well, let me know
offline. Near Houston lobby.
Oh, Hobby?
Hobby. Near the airport. So it's not too far away from the airport.
All right. Sounds good.
All right, brother.
All right. I'll see you guys in a minute. I'll play the outro. You can hop off. You don't have to stay if you don't want to.
Yeah.
All right, everybody. Cheers.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Or look at it say, it's beautiful!
Welcome to the fucking show.